Hello and welcome back to Market Brief After Hours. Today was one of those days where you look at the screen and just see a sea of red. The geopolitical temperature got turned up a few notches, and the markets, well, they didn't take it too well.
That is putting it mildly. We witnessed a classic textbook risk-off session today. The trigger? It all circles back to Washington, specifically renewed tariff threats from Donald Trump regarding Greenland. But it's not just about an island. The rhetoric has expanded to put Europe firmly in the crosshairs. That reignited trade war fears in a major way, and investors ran for the exits.
It felt heavy right from the open. Let's look at the damage on the major U.S. indices. We saw the worst session since last October for the broader market.
Exactly. The selling was aggressive and broad. If we look at the S&P 500, it tumbled 2.06%. It settled at 6,797. That drop effectively erased gains for the year, which is a psychological blow for bulls. The Dow Jones Industrial Average wasn't spared either. It shed over 870 points. That's a decline of 1.76%, finishing the day at 48,489.
And the Nasdaq usually takes the brunt of it when rates and risks rise.
And it did again today. The Nasdaq Composite led the declines, sliding 2.39% to close at 22,954. We saw high-growth tech stocks, specifically the Magnificent Seven, facing aggressive profit-taking. When you have threats of new tariffs clouding global supply chains, tech is often the first to get hit.
Let's dig into the catalyst here. You mentioned Greenland, which sounds almost obscure, but the implications are global. What exactly is spooking the street?
It's the escalation. We aren't just talking about a real estate deal for Greenland anymore. The market is reacting to the threat of 10% to 25% tariffs on 8 European nations. On top of that, there were specific warnings of massive 200% duties on French luxury exports. This is the weaponization of tariffs, and it sent a chill through trading floors across the Atlantic before the U.S. even woke up.
So let's talk about Europe. It sounds like a difficult day for them as well.
It was a broad-based retreat. The Pan-European Stock 600 declined by 0.72%. If we look country by country, London's FTSE 100 fell 0.67% to 10,127. The French CAC 40 dropped 0.70% to 8,055 points. Luxury names obviously weighing heavily there. In Germany, the DAX shed 1.06% to close at 24,696. And Italy's FTSE MIB slumped 1.11% to 44,695. Even the Swiss market, usually a bit more defensive, lost 0.81%.
Interestingly, despite the gloom, I saw a data point about German morale.
Yes, a rare bright spot. The German ZEW index, which measures investor morale, actually rose to 59.6 points in January. It shows some underlying resilience in sentiment, even if the price action today didn't reflect it.
Now, usually when stocks crash like this, we see a flight to quality into U.S. Treasuries, driving yields down. But that didn't happen today, did it?
No, and that is arguably the most concerning part of today's action. We saw a sell-off in bonds alongside stocks. Treasury yields spiked. The benchmark 10-year Treasury yield rose more than 6 basis points to 4.295%. And the 30-year spiked to 4.92%.
Why would investors sell safe haven government bonds during a panic?
It's a reassessment of sovereign risk. Investors are worried that if trade wars escalate, international demand for U.S. debt could dry up. We actually saw a major Danish pension operator exit the Treasury market today. That's a tangible sign of capital flow shifting. When foreign entities stop buying or start selling U.S. debt because of geopolitical rhetoric, yields have to go up to attract buyers. It complicates the picture significantly.
It certainly does. We're going to take a very short break. When we come back, we need to talk about the currency markets because there were some fascinating technical moves in the euro and the pound. Plus, we'll look at the commodities that did act as safe havens today. Stay with us. Welcome back to Market Brief After Hours. We've covered the equity sell-off and the strange behavior in the bond market. Now, let's turn to Forex. With the dollar weakening against major peers, there was a lot of action on the charts.
Absolutely. The currency markets really reflected that shift in positioning. Let's start with the euro against the dollar, Euro USD. It closed at 1.1722, up 0.64%.
And I understand this move broke through some key technical levels?
It did. It posted a strong bullish daily candle.
Crucially, it reclaimed both the 50-day moving average, which sits at 1.1659, and the 100-day moving average at 1.1663. It's also remaining firmly above the 200-day average at 1.1588.
So reclaiming those averages suggests a momentum shift?
It confirms momentum is back in favor of the upside after some recent consolidation. Immediate resistance is now at the session high of 1.1769. If it breaks that, we're looking toward 1.1800.
What about the British pound?
GBP USD also had a constructive day, ending at 1.3436, up just 0.07%, but the technicals are what matter here. The price closed back above the 200-day moving average at 1.3406. That signals renewed medium-term support. Below the price, you have the 50-day at 1.3334 and the 100-day at 1.3364, both sloping upward. As long as it holds above that 200-day line, the bias remains mildly bullish.
And briefly on the Aussie dollar?
The AUD-USD is maintaining a very bullish structure. It finished up 0.34% at 0.6736. It's sitting on top of a bullish stack of moving averages. The 50-day is at 0.6617, the 100-day at 0.6588, and the 200-day at 0.6532. The breakout above 0.6720 keeps the momentum intact.
Okay, moving from paper money to hard assets. If treasuries weren't the safe haven today, where did the money hide?
Precious metals. It was a gold rush. Gold surged to an all-time high, closing at $4,759. That is a massive 3.56% move in a single day.
That is incredible volatility for gold.
It's in a powerful uptrend. To give you context on how extended it is, it's trading significantly above its 50-day average of $4,299 and the 200-day at $3,695. We are in price discovery mode. There are no historical resistance levels overhead. The next psychological test is probably the $4,700 support zone if we pull back, but right now the bias is extremely bullish.
And silver?
Silver is going parabolic. It ended at $94.36, up 4.75%. It's trading far above its 50-day average of $65.23. It's driven by intense buying pressure, though we did see a long upper wick on the candle, suggesting some profit taking near $96. But the trend is overwhelmingly positive.
We also saw oil prices gain today, but was that trade related?
Not exactly. That was more supply-side dynamics. Brent crude gained 1.53% to settle at $64.92, and WTI rose 1.51% to $60.34. This was driven by production halts in Kazakhstan. There were power distribution issues at the Tengiz and Korolev fields. That supply disruption put a floor under energy prices, offsetting the worries about global trade slowing down.
Now, usually when we talk about risk off, crypto takes a hit. How did Bitcoin fare?
Bitcoin acted like a risk asset today, not a safe haven. It fell sharply, declining 3.78% to $89,567. The geopolitical tension undermined appetite for speculative assets.
And this impacted the crypto-related stocks, too.
Heavily. Strategy, MSTR, slid about 6.6%, and Marathon Digital dropped over 8%. Interestingly, though, Strategy disclosed they bought another 22,305 Bitcoin recently, worth over $2 billion. So they're accumulating aggressively even as prices dip. It highlights a disconnect between their long-term conviction and the market's short-term fear.
Let's wrap up with the market movers, the specific stocks making headlines. You mentioned the Magnificent Seven earlier.
Yes, Nvidia and Tesla were the laggards there, both closing down more than 4%. High-valuation stocks are very sensitive to these trade war fears.
But there was one massive winner today.
RAPT Therapeutics. The stock skyrocketed more than 62%. GSK agreed to acquire them for about $2.2 billion. In a sea of red, that was the place to be.
Any other notable movements on the downside?
NetApp tumbled over 9% after Morgan Stanley downgraded them to underweight. And 3M Co. fell more than 6% after their full-year earnings forecast missed analyst expectations.
Finally, we had Netflix earnings. A bright spot?
A solid beat. Netflix reported earnings of 56 cents per share against expectations of 55 cents. Revenue was $12.05 billion, slightly ahead of consensus. But the big number was subscribers. They reached 325 million global paid subscribers. It's a new milestone, and it shows the streaming giant is still growing despite the macro headwinds.
So to summarize, tariffs are back on the table, stocks are down, yields are up,
and gold is at record highs. It feels like the market positioning has been reset.
Completely reset. The capital flows we saw today, out of stocks and bonds, into gold and cash, signal that investors are pricing in geopolitical risk, not just economic data. With the rhetoric escalating toward Europe, we remain vulnerable to volatility. Positioning is going to be highly reactive to headlines in the sessions ahead.
We will certainly be keeping an eye on it. That's all we have time for today. If you find this useful, please follow Market Brief After Hours for your daily breakdown. Thanks for listening.